Hey, folks, Sunday around 4 p.m. Eastern, we're bringing to you our next live show, Lumida Non-Consensus Investing. My kids are taking a nap, so I had some time here. Thought I'd share a few observations as we go through the holiday season. I hope you're all having a wonderful holiday season. I was at American Dream Mall with my kids last night. It was completely packed. It was packed. So I can tell you the retail consumer is alive and well, and retail stocks are showing that, whether it's American Eagle, Abercrombie and Fitch, Victoria's Secret, you name it. They're all doing well. Most of them, I would say, are doing quite well. So I want to talk about a few topics. One is, OpenAI and the semiconductor complex, themes that we're focused on, themes that are working, talk about where we are with high beta, some of the macro stuff, growth to value, can even share some ideas we've been investing in generally too. And if you have questions, just ask along the way too, and I'll do my best to address those. I'm going to focus on some of the content from the Lumida Ledger newsletter, which we drop every Sunday at 11 a.m. Eastern time. So there's a lot more content there and a lot more depth around macro and markets commentary. So I'm not able to get into everything here. We also highlight the best takes and curations from podcasts that we think may be interesting over the course of the last week, just to save time. So you may want to take a look at that if you're not there. Thought I'd start with OpenAI and the semiconductor complex. There's a lot of markets around this: Google, OpenAI, Oracle, CoreWeave. There's so much happening here. Let's unpack this. So let's first off, I want to share my screen here. This is a chart showing the rapid rise of AI chatbots. And what you see is this path to 1 billion users. You can see ChatGPT set a record to get to 1 billion users in 1,100 days. By the way, that's a big number, 1 billion users. Let that sink in for a moment. 1 billion users. Remember the whole everyone should get a laptop policy that was 10 years ago? That mission was accomplished. You go to Best Buy, you get a Chromebook. Capitalism delivered the $100 laptop solution, and it also delivered intelligence in the palm of people's hands. A really incredible feat of human ingenuity. So one of the few apps, maybe the only apps, to grow faster is Google Gemini, 900 days. And on the evals, Gemini scores well. There's this race. There's a race between ChatGPT and Gemini. You might call it a race to the bottom from a CapEx perspective. There's another race. There's a race to public markets. Anthropic, which is a competitor of ChatGPT, is looking to get into public markets before OpenAI. Very wise, very smart of them to do that while they can, right? If you're a leading LLM and you're the first to be offered in public markets, then you're a scarce asset in public markets. You can do better and you can benefit before what I would view as the inevitable cooling effect or fading of an IPO, especially an offering as big as OpenAI. So it's very, very smart of them to go into markets. And the CFOs of these companies are very sharp. They know what they're doing. They're very thoughtful people. They understand what's at play here. I think one of the key messages from this is that distribution matters. This is a topic been coming back to over the last 2 years, and why we like Meta and Google. They both have distribution. They both have the end user, and Google has apps like Google Docs and Gmail, so they are well positioned with the customer. They have a daily intimate experience with the customer. By that I mean they have access to their private information, like their calendars and their emails, who they spend time with, their social interactions, their friend circles and networks. So they're in a really unique position, and they're able to layer on AI and see explosive growth, and that's what you're seeing here. I think they have an incredible competitive advantage, and it's going to be hard for ChatGPT to compete longer term with all this, with the rise of and proliferation of other competitors coming online too, right? I mean, the history of technology is where you see rapid growth and revenue, you see competitors say, gee, how do I participate in that? Microsoft too, right? Microsoft, they have an investment in OpenAI, but they also have a hedge by internalizing Perplexity and their own offerings. They're also competing with OpenAI and enterprise. Then on the enterprise front, OpenAI is competing with Palantir and other firms that are more specialized after narrow use cases. I expect all of that to continue. Specialization is the nature and tendency of markets. That's just the way it goes. And firms that are specialized on a customer target, they know that customer target, they can deliver a unique value proposition, they can find that customer, they can build brand awareness and service the customer. So this is kind of like the death of a thousand cuts if you're a leading LLM player. So, I'm a big believer in AI and the transformational potential. We've been consistently talking about the growth and productivity we've seen over the last several years. I expect all of that to continue. I think part of that is AI driven, and it's going to broaden and deepen to the 493 or to the real economy. You're seeing more of that happen. And the CapEx you're seeing now is contributing an incremental point to GDP. That CapEx is a benefit to the US economy for rising productivity growth, which is going to help address inflation and improve corporate incomes and real incomes. That's all a good thing. But you want to be careful about the FOMO here. You want to be careful about FOMOing into these opportunities that are too obvious. So one of the points I made in an FSD, so I've been doing these regular FSDs now when I drive to and from work. Usually it's around 7 a.m. in the morning and then 5 p.m.-ish on Twitter in a live stream. And I just walk through some of the headlines that we're seeing and how we're processing information in real time. But one of the points, I made is that, you've got this issue with semiconductors and really this data center complex that's relying on an assumption of massive CapEx spend continuing. So to put it in perspective, you've got thousands of data centers that are built around CPUs, somewhere between 2,000 and 12,000, depending on how you dimension that. If you're looking at just hyperscalers, it's around like the 2,000 mark, plus or minus. If you interpret data centers more broadly, including like co-locations, you get to like 10,000. So that's got to transform to GPUs. And that's a real structural shift. Is driven by not just enterprise, but also governments and increasingly defense, right? You're seeing defense contracts now get inked. This is something we've been talking about as well. Like governments are getting behind AI. It is a geopolitical topic now, right? Saudi Arabia is lobbying to get access to NVIDIA chips to build 60 data centers, for example. Macron in France is talking about nuclear energy to fuel data centers. China's already all over this, of course. So, it's a real transformation that's going to take place. Because one of the issues, though, is the funding needs. Where's the funding coming from? The primary funding needs the funding is coming from, these Mag 7 companies that have mostly loads and loads of free cash flow. Companies like Microsoft, Meta, and Google have lots and lots of free cash flow. So it's sustainable, unlike what you saw in the dot-com bust, where the quality of the clientele wasn't as strong. You had more venture-dependent funding. So it's just that was less sustainable in that. And in that area, you also had dark fiber. You had fiber optic cable going online that wasn't ROI positive. Here you can see it's ROI positive. You look at the cloud businesses for Google, Microsoft, they're positive, and Amazon, double-digit growth, and they're making money renting out GPUs. So that story is a real story. The issue is around what happens 2 years and 3 years from now. Okay, so OpenAI CEO Sam Altman had an interview with Brad Gerstner. He said, look, actually, Brad Gerstner asked him, hey, how are you going to fund these $1 trillion in commitments if you're at 13 billion going higher? And Sam had this defensive reaction. And apparently it looks like they're going to clock in at, 20, 25 billion by year end, by the way, with the path to 50 billion in the next 2 years. And, so Sam had a very defensive reaction, but it's a very legitimate question. So what's been weighing in on this data center theme, which is the primary theme in markets, which is why I'm focused on it and why you should be too. It's the primary theme that's active in markets is the AI theme. Is where's the money going to come from? Is the money going to come from operations? That's sustainable. In the case of the hyperscalers, it's sustainable. Or is it going to come from venture funding or public markets IPO funding? Both of those have limits. And if markets start to expect that the outer envelope of CapEx spend comes in because it's not clear how you get to $1 trillion in funding, then you're going to see markets discount players in that data center theme. And that's what we saw in the last kind of week or so. Now, what's interesting about this is that you saw a reversal of a 4-day decline in semiconductors starting mid to late last week, like Wednesday and Thursday, when there was a news report leaking the information that OpenAI is planning to raise $100 billion by end of Q1. That lit up a rally, 1% rally in the S&P. The following day, the Wall Street Journal had an article talking about this funding round 2. S&P goes up another percent. So, the market's saying, gee, look, if they can raise $100 billion, then the music keeps playing, the show goes on, because you're going to kick the can down the road, right? Markets aren't going to look 5 years from now. The markets are going to say, okay, Sam, Oracle's good for it. Oracle's good in terms of their debt if you can raise $100 billion or more than good, because you're going to be able to meet and honor your commitments to Oracle. So that's why the markets rallied. That's why semiconductors rallied. And, in markets, there's usually one primary variable at any given time that drives market beta. Markets are very simple. So in November through December, the primary variable was, what's the expectation of December Fed rate cuts? And it went from 25% to 90%. And then, of course, the Fed cut rates, markets rallied. In June, it was the whole Iran-Israel geopolitical risk. That was what markets were focused on. And now markets are focused on this OpenAI funding round. That's what I claim anyway. So markets, especially the semiconductor and the data center complex, are going to turn on the perception of OpenAI ability to achieve that funding. I believe they will. I wouldn't want to be an investor in that. That's what makes investing complicated, right? You have to hold multiple seemingly contradictory ideas in your mind at the same time. I don't think OpenAI is a good investment. I also don't think they'll have any problem raising the money. They're going after sovereign wealth funds. The joke I like to say is that when you raise money from sovereign wealth funds, it's like last call at the bar. Things get really sloppy. Valuations get loose. It's not tight. And the big question there is Brad Gerstner and Altimeter, are quote unquote smart money investors, going to get involved in that deal? If they don't get involved, it's a negative signal. Or if they get involved, but for like a token amount, it's a negative signal. I really wonder what Brad would do here. In October, he said he would want to invest more in OpenAI. Well, here's his shot. He can pay up at a 50% higher price. They're talking 850 billion post money off of around at 500 billion just a couple months ago. But you can't raise beyond sovereign wealth funds. You can't raise beyond SoftBank and the sovereign wealth funds. It's really public markets as your last stop. There's no other planet that has capital to invest, right? You've really tapped out at that point, and you've got to go to public markets. So, they got to go to public markets because they need the funding. That's the key thing, to fund the CapEx. So that's what they have to go do. It is kind of amazing how everything one day or another does come back to cash flow, one day or another. I shared in the Lumida ledger this study that was done about the factors that hedge funds look at, and free cash flow yield was the number one metric. It's a metric I look at every time. You've seen me write about that even last week when we wrote about Comcast free cash flow yield, Norwegian Cruise Lines free cash flow yield. It's not a sole determinative metric. Doesn't really work for like Mag 7 companies, for example. But when it's elevated, it's usually not a bad time to buy. But everything comes back to free cash flow. And where does cash flow come from? It comes from operations, which are sustainable. It can come from financing, but that can turn on access to public markets. So as long as public markets are open and people want to invest in the story, then things can continue. The bigger picture is that with Google and Meta, you've got the rise of the freemium model. These are very skillful competitors, and they want to crush OpenAI. They don't want to let someone else into the game. They have ad-funded models. Right? What does that mean? It means they're not going to charge for AI. You can get AI in your WhatsApp across billions of users. You can get AI in Google Doc across billions of users, and you don't need to pay a subscription. That's the issue for OpenAI. You're an app that's a specific form factor. You're a chatbot, really, a chatbot. It's a specific form factor, and you've got competition coming from all sides, including Grok and others. So, I think they're in a difficult position, but that's the key thing to focus on is, can they raise the funds? And look, $100 billion raise with quality investors will be the home run scenario. If that happens, you're at all-time highs. If you see half measures, or you see a partial funding, or you see low quality investors, or you see a $50 billion round, then that's not good. And I think they'll get it done. I think they'll get it done because it's in U.S. interests also for this deal to get done. So the U.S. will not block and might even quietly encourage a funding round to get done. That would be consistent with American AI policy, wouldn't it? That would also help NVIDIA. That would also help just American AI dominance versus China, which is a real competitor in AI. Necessity is the mother of invention. You see how China has innovated really skillfully with constraints around access to GPUs, whether that's a DeepSeek or a number of unique models now. So, look, like the Middle East nations have been supportive of current American policy. If you look at where the price of oil is. And I think, you're seeing that with the UAE and the US and Qatar and all sorts of things. I could see them investing in OpenAI. That's a unique angle I don't think people are considering, right? I do think that there's a geopolitical angle, and I think that helps Sam. Sam was at the White House, don't forget, not too long ago. It's in the interest for a lot of people to see that funding round get done. So I think they'll get it done. And for that reason, we got Mark Cuban on the bottom right here. Look at this. I'm gonna go. What's that show called? This. For that reason, I'm out. No, I'm kidding. For that reason, well, I am out of OpenAI, but for that reason, I do think that they get the funding done. That said, I think positioning in current markets it's really unique kind of set of dynamics. We'll talk more about that. Still have a bias towards value here, although I do think you're going to get. I think there's an opportunity for like these high beta names to rally. I do think names like Oracle and CoreWeave have likely seen the lows. I mean, markets have priced in a lot of bad news, and I don't think the CFOs of these companies are knuckleheads. What we don't know is the quality of the contract between OpenAI and Oracle. What counterparty risk is Oracle taking? When Oracle has to make a 5-year plan to lay out CapEx and build a big data center install, they're relying on OpenAI, right? OpenAI might only front 25 to 35% of the investment initially. So the balance of that has to be funded. And if Oracle doesn't get paid for that, that's the risk. But I think what the market's missing is that the demand for this infrastructure is significant. Whether it's OpenAI or someone else, they can assign the contract and it'll get filled. That's going to happen. And the new line of NVIDIA GPUs, the Blackwell series, is far more energy efficient. So there'll be an upgrade cycle. So it'll get filled. That's the big picture, right? It's a complex story, isn't it? There's a lot here. I don't think I'd spend 15 minutes on OpenAI, but there you have it. Look, it's the primary story that's driving data center, QQQ. So you got to spend some time on it. Let's shift gears here. So I think, the themes that I'm more focused on, like on private markets, I think it's really defense tech. And I think this strikes me as like fairly obvious. The backdrop is that a lot of these amazing companies are just staying private for longer. and that's depriving public markets investors of incredible investing opportunities. SEC Chair Paul Atkins talked about this. He said, look, we've got fewer U.S. listed securities in public markets than we've had in decades. This is something that my friend and mentor, SEC Chair Arthur Levitt, also was focused on even 15, 20 years ago. It's been a declining trend of the number of investable opportunities in public markets. The compliance costs are higher, the burdens are higher, quarterly earnings are more challenging to manage. It's difficult running a public company. And not only that, but these, the VCs and the PE firms just hanging on to these businesses longer and capturing more of the public market's value. Part of that is the realization when you look at these Mag 7 companies of how incredible some of these businesses are. So much of the gains, in fact, most of the gains for, like, say, Google happen in public markets, not in private markets. You could have invested in Google, I want to say like a $23 billion valuation when it went public. Now it's trillions in valuation. If those VCs just held on longer, they would have done that much better, right? That's part of it. Another part of it, more cynical side, is that there's a big bid-ask spread between the valuation that firms are willing to accept in private markets and what you see in public markets. There's a big bid-ask spread. Part of that's just funny money dynamics. You saw this with the private credit fund that listed. It was a private credit fund, meaning it was not publicly listed. They listed it, and then I think it opened something like 18, 20% lower. It was terrible because it was mark-to-market discipline that was enforced. And so you saw what the true value of this thing was. That's some of it. But with public markets at high valuations, more transactions are getting done. Companies that are in the M&A thematic basket that Goldman maintains are outperforming. So more M&A deals are getting done. Look at the stock price of Goldman Sachs. Think other names like Jefferies on the investment banks. They're doing well because they're going to see more M&A, especially in an environment where you have an admin that's constructive around M&A. People are looking at what's the consequence for failed M&A deals. And some of these companies have gone bankrupt. Like I think iRobot went bankrupt. It was denied by the FTC and the prior admin. The company is gone. Could have been $1 billion in value creation for someone or some shareholder management team. But I do think defense tech is a really interesting area. This has been talked about by like Pete Hegseth. He's saying, look, we got to refactor, and you're shifting to this kind of drone first, highly attritable, volume-based platform away from these big carrier battle groups that are expensive, bulky, and easy targets. And obviously, you've seen drones play out in Ukraine, and it's going to play out in Taiwan. This is pretty straightforward. It's also linked to the AI theme. So I think this is the area to focus on. We saw the digital assets theme play out. That hit its culmination with the Circle IPO and the Genius Act getting passed in July. That was the top of the market for digital assets. Not unlike when Coinbase went public in 2021, that was the top for digital assets. IPOs are often, when you see the elephant go public, it's like, okay, party's over, got to move on. So I think you've seen that there. I think in AI, you're getting there. Anthropic and OpenAI we'll see. We got to see the S1, the numbers, but the market is acting with a lot more discipline now. But I do think this defense tech story has some legs to it. Anduril has been a name I've been talking about for 2 years. I've been talking about Tether for a few years too. I couldn't get into that. Now I can get into Tether, but it's too expensive and interest rates are declining. They make their money by borrowing short, lending long, and they lend against U.S. treasuries, and treasury income is going to drop with rates going down. So that's hard. That's hard, right? So Anduril is expensive, but I think there are these like kind of runner-ups to Anduril, so to speak. There are 3 or 4 interesting companies out there, folks in this category. We're focused on that. Unfortunately, you can't really access some public markets. I wish you could, but you really can't. How do you do that? Let me know if you find a way to do that. I don't see companies out there that give expression to that theme. So we brought on John Cutrone, who's a superstar. He's got multiple cycles of investing behind him, and he's sourcing deals and opportunities there. So self-plug, check out lumidadeals.com, lumidadeals.com to get on our list if you're an accredited investor and we can share what we are investing, what I'm investing in. But I do think those are the opportunities from the pre-IPO side. You got to be a lot more selective. On the macro, I'll keep it high level. Growth is tracking at 3.5%. What's really funny? I was on a call sheet. I do these like sauna things in the evening, and I do a Twitter Spaces live, kind of like every other day. I'm tracking now. I checked the betting probabilities and said the markets don't expect a 3.5% GDP growth next year. I think that could absolutely happen. You got stimulus checks coming. You got productivity growth. You've got corporate earnings at all-time high. There's still a lot of PTSD out there that people have, and psychology is just broken. A lot of it has to do with for political reasons. A lot of it's politics. People feel, tension. But the real economy is doing more than just fine, folks. Okay, so I had a podcast called "Is This Goldilocks?" in the end of October. It is Goldilocks. People just don't realize it's Goldilocks from a real economy perspective. That's not to diminish the real challenges people have. It is a K-shaped recovery. It's not to say that there aren't things that need addressing, but like the big picture is you've got earnings growth, you've got disinflation, you've got productivity growth, and you have the ability for companies to refinance their debt. And you've got a Fed that wants to cut rates despite inflation being well above their 2% target. They're tacitly accepting 3%, which is bullish for real assets. That's the big picture. There's always issues. The 1970s was a lot worse than where we are today. Far, far worse. The civil rights era, stagflation era, the Nixon era, moving off the gold standard, the OPEC crisis. It was far worse than what we've got today. You didn't have AI, you didn't have technology there. There's never been a better time to be alive. Okay, so keep that in mind, maintain perspective. So, I mentioned earlier, like I was at the mall last night. It was packed. It was so packed. I kind of wanted to go home. In fact, there for an hour, we checked out. I do want to go more often, though, only just to get a read on things. I think it's interesting. I stopped by a few stores and get to see themes and trends. Now, you got to realize this economy is a service economy. It's not a goods economy. So I think people kind of forget. This is a baby boomer economy. People are consuming services. What does that mean? It means healthcare. It means restaurants. It means elective health. It means like acupuncture services. It means daycare, child rearing services, senior living. Look at names like Welltower, which are like, the returns on these things have been quite high, right? That's the economy we have right now. It's not a goods and merchandise economy. It's not the big driver, right? So when people say, people talk about issues around retailers, first off, their stocks have been doing really well. A lot of people thought there was a recession because those stock prices were down, but they're missing, the fact that the economy has shifted. It's not a manufacturing economy. This is a services economy. The manufacturing data is still weak. Doesn't matter. The game has changed. The way you look at the world has to change. We have a dynamic market economy, and it's always refactoring itself. So this is the boomer economy. It's fueled by boomers. Boomers are the lender of last resort. I read about that in my newsletter here, right? Boomers are doing the lending now. The U.S. government's borrowing more. Corporates are borrowing, like Amazon, to fund CapEx. They're borrowing $10 billion, increase their CapEx. Oracle's borrowing. So, the three sources of borrowing and lending in the economy is the U.S. government, corporates, and the consumer. U.S. government's levering up. Corporates actually are cash rich and cash flush, and they're doing $1 trillion in buybacks, by the way. But on the margin, you're seeing more levering there. So it's consumers, baby boomers, that are lender of last resort. Isn't that funny? The lender of last resort is the boomer. You can't make this up. But it's true. That's what's happening. So, fortunately, the household balance sheets are strong. No recession in sight. I won't go through all this, but we talk about automation in the newsletter, the categories that are most at risk. There's an interesting Twitter post I saw. We also highlight really interesting insights on X that we can drop in our newsletter and shine a light on people that are making, thoughtful contributions. But here's one. It's Andrew Curran. He talks about the story about a lawyer who drafted some legal doc. Took him like a day and a half, and he's a super lawyer. He used Grok super heavy or heavy AI, did it in 30 seconds, and he is quote unquote spectacular, actually staggering. It did it in 30 seconds, and it was much better than mine, period. And remember, I am very good at this. And he says, how can any of us compete? Question mark, we can't. So he's kind of lamenting the disruption of the legal industry. And obviously, you're seeing less hiring in financial services, less demand for analysts. I wouldn't be a doomer on all this stuff, though. Look, the fact is, licensing still exists. Lawyers have to represent in court. Doctors have to perform surgeries. Accountants have to sign off on accounting. You still have someone accountable. You still have someone with accountability. And that's how a lot of frameworks around the world work. It's a concept called throat to choke. There's always a throat to choke. So those persons are becoming more and more productive, the ones that can adopt AI. What it really means is that firms that can adopt AI are going to see an acceleration in their market share capture, an acceleration in their margins expansion, and they're going to eat up others around them. That's what's going to happen. They're going to do really well. So you've got to be AI first, and you got to adopt AI technology, and that's what's happening, so that you're showing up in productivity growth. And I think it's set to continue to grow and accelerate because it's still early days. How many of you in your organization are AI native through and through? Don't you see opportunities all around you to make it better? So, on the market side, here's some interesting charts I like to look at. Here's one. This is from the Global Fund Manager Survey. It shows the cash levels have dropped to about 3.3%. And when cash levels, this measures global money managers. It's a contrarian indicator. I'm a contrarian, so I like data like this. But what it's saying is that when there are very low cash levels, then forward returns, 1 month forward for one of these MSCI indices is around -2%. The intuition here is that when everyone's bought, there's no one left to buy. You'll notice here that when cash levels are extremely high, those usually coincide with market bottoms. So I don't like that. And this kind of plays into my growth to value rotation thesis, which I've been sharing over the last several weeks. And here's another one. It's a B of A bull and bear indicator. And this measures sentiment. And it goes from extreme bearish, which is a buy signal, extreme bullish, which is a sell signal. This accurately actually marked the 2022 January top. This was an extreme bullish territory, like it is now, actually. So, I think valuations are elevated, so you got to pick and choose your spots. I think you can still make money next year. I think the S&P will have an up year next year because it'll be driven by earnings growth, productivity growth. But when you fit this together with midterm elections, which generally have like a drawdown, post-financial crisis, average drawdown is around 7.5%. If you look before the financial crisis, the drawdowns are deeper. But, I think you put this together, you probably see a pullback sometime in Q1. Maybe you get a nice Santa Claus rally now, and you probably see some kind of pullback there and a reset. But it is a stock picker's market. The way you can tell that is if you look at the 3-month pairwise correlation across stocks, it is very low, very low. What does that mean? So you have a correlation matrix. You have, let's say, 500 assets and one axis, 500 assets and another axis, and you measure their pairwise correlations. Okay. That average correlation is very low. That means that stocks aren't rising and falling together. And that means that it is a stock picker's market, which is fantastic. We like stock picker's markets. That's good. I'm looking forward to this. Hopefully, you've been following our newsletter. We wrote about Comcast last week. No one's talking about Comcast. We lowered it last Sunday, went up 7% this week. That was fun. A lot of good names out there. Molina Health, we wrote about 2 weeks ago. There are good things to do out there. There are good things out there. So it's still a bull market. A lot of this, I believe, has to do with just positioning, which means how do you allocate within the market? What industries, what themes, what factors do you expect will work? I do believe value will be a factor that works and will do well. In the last year, the best factor has been international value. International stocks have trounced the United States. It turns out these international stocks also have a lot of exposure to value factor, like Brazil, 40% plus year, Spain, 40% plus year. We own Santander there. We own Nubank in Brazil. We own PagSeguro in Brazil. So they're good at, that's value, right? And it's applying itself on the US markets too, right? It has been. I mean, Nike hasn't really done much, keeps dropping. It's still more expensive than Meta, Nvidia. It's got like a 33 times earnings. It's deflating. People read too much Peter Lynch and said, buy what you know and own. And they kind of missed the main lesson. And Peter Lynch was valuation sensitive. But there are other opportunities out there that have value that have done extremely well. So, one of the areas that I think is super interesting are like so I know it sounds incredibly boring. Believe me, it's boring, right? Utilities, right? What's powering the data center? Utilities. The world needs more energy. The fundamental constraint is access to utilities. It's hard to start utilities. Nuclear energy is not coming fast enough. So utilities, I don't think I've ever owned Con Edison stock. I don't think I've ever owned I bought it 2 Fridays, the Friday before this past Friday. I'll show you real quick here. This also is a nice little insight into what like charts do have a role to play. Right here, we bought green right there. You see those levels right there? This thing is, utilities. I think utilities can do really well, I think utilities can do well. I'll say it like that. The issue with utilities and really low beta stocks is that if you have a bull market in the S&P, then you might lag because utilities and other names don't have enough beta. It's like the beta on these names could be like 0.6. So, that's an issue. And a lot of, investors don't talk about this, but how do you solve for that? How do you solve for that issue? I'm going to show you how you might solve for this. This is an interesting concept. And anyone that studied corporate finance in school has learned about this concept in, they call it modern portfolio theory, right? The efficient frontier. I'll share very briefly here. You can read more about it in my newsletter. This is a little on the wonkier side. Then I'll move back to kind of other topics here. But yeah, so I claim that utilities are right here, this tangency portfolio. It's the most efficient. It's one of the more efficient returns per unit of risk. The problem is that the volatility in the beta is less on the market. So you might actually, you'll have less risk, you'll have higher risk-adjusted return, but you're better off finding a way to get more exposure to utilities. And how do you do that? This is why 130/30 funds exist. Theoretically, you'd want to short something to fund that to own more utilities, to get more long utilities, or increase your net exposure to that. It's really just a math thing. But these are the things that people aren't talking about. And when they do investing, like that stuff matters. The beta matters. So I'm going to shift gears back to some of the highlights here. Warren Buffett does that, by the way, too. Warren Buffett, he owns a bunch of low beta names in the insurance sector and the financial sector. He owns low beta names. And what does he do? Well, he has AAA rated debt that's non-callable. He can't get margin call risk. It's not prime brokerage. It's corporate debt. And it's AAA, so he funds it very cheaply. And the business he invests in, they're wide moat business that throw off boatloads of cash flow. Again, so his interest coverage is more than good, and he can pull the trigger if there's a dislocation because he's throwing off so much free cash flow. And then he can expense the interest. But that leverage again, appropriate leverage here also allows him to increase the beta of his low beta portfolio to get something closer to a market beta. Warren Buffett doesn't talk about that, but that's exactly what he's doing. You can fact check me with GPT. That's one of the many things Warren Buffett does, not the only thing he does. He does many other things. I've at least 3 other podcasts talking about what Warren Buffett does. Usually in May, I talk about that. But that's one of the things. That's one of the things he's doing, isn't it? So, theoretically, you would want to look at like maybe call options if the implied volatility is low, but you got to approach it the right way, and you really have to know what you're doing. So I kind of hesitate to talk about this stuff, but it is interesting. It's very interesting to think about. If you're transitioning to a low beta value environment, certain names don't have enough beta. So how do you get the right expression for your portfolio? That's really the problem statement, right? So what else? Yeah, I think CoreWeave. I think the lows are in for these names, and Oracle and CoreWeave. I think kind of here's a funny tell. I remember, was it like 4 months ago? You saw Oracle CEO was in the headlines, one of the wealthiest people in the world. CoreWeave CEO, same thing, right? The Forbes lists. And then this week, we had 2 articles on CoreWeave. One was called like Fall from Grace, and then another one the next day. At that point, everyone in the world has seen these articles. They've had a chance to express a view. Okay? What's not priced in now? And now if OpenAI raises their funding, then, well, that helps certainly Oracle. I think CoreWeave has tighter contracts. They have tighter contract take-or-pay contracts, more secure counterparties. So, and you had Jim Chanos the weekend before talking about this whole thing. So he wasn't exactly bearish. He just said the over-under on this comes down to the useful economic life of the GPUs, which is correct. That is the correct take. Now, if you look at the CPU world, there are data centers out there that have been around for 10 years. Will that happen in GPUs? I don't think it'll be 10 years, but I think it'll be more than 3 years. I don't think it'll be 10 years because the energy consumption on these GPUs is so much higher that they will need to upgrade. That upgrade cycle will still help companies like NVIDIA. So the question is, what does it mean for these kinds of firms? But overall, I'd say there's so much bad news priced in, like the price to sales ratios, which is the right metric, I believe, to look at a company that's doing rapid investment is high. Where I'd be worried is about companies that are the CapEx payers like OpenAI. I'd be worried about that because, CapEx is this technical word. It's not capital expenditures, but fundamentally they are expenses, right? So if OpenAI does 25 billion in revenue at year end on a path to 54 billion, let's say in 2 years' time, but they've got commitments for $1 trillion in spend. Let's just divide that in 2. Suppose your commitments are 100 billion. You have to underwrite that. You have to underwrite that delta, which is a big delta. There's a lot of expenses that, we can DCF the expenses. We know the expenses are there. We don't know that the revenue is there, right? So if you're an investor, what side of that do you want to be on, right? The other part around this is I would say like, it's another edge to pre-IPO investing. We have distributed all of our interest in CoreWeave. All of them made money and good money, which is great. You can go to luminadeals.com, see the returns on that. But if you can get in before these companies not IPO, not at the IPO. Look at Figma when it IPO'd. Look at Robinhood. Robinhood offered Figma to their clients at the IPO day. Let me show you a chart of Figma. Then I'll show you a chart of Circle. This is one of the reasons why like public markets is hard, right? This is Figma. If those are following live, you can see that it opened, topped 2 days later. Everyone's in, $122 a share. Now it dropped to $40. That's a big, big drop. And then Circle opened, had a nice rally, kind of opened around 78, some $80, then went to 280 in like 2 weeks. And now it's back in the high 80s or so. But, those recent IPOs do look like they're stabilizing a bit. So that's a good sign for high beta in their short run, which is good. That's good for, markets in the short run. So let's see. The other thing I'm noticing again is like I go back to the baby boomers, like what's working? Cruise lines. What are baby boomers spending on? Travel and leisure. They're spending on experiences. So what's wild is like you could have bought Norwegian Cruise Lines at like 7 times earnings not too long ago. That's insane. It's had a nice rally in the last few weeks, along with other consumer discretionary names, right? Consumer discretionary has done extremely well since the November lows, which is right around here. That was the buy point to go get consumer discretionary. Okay. So I think that category will still do well next year. That category is stronger than people think. Household balance sheets are strong. Spending is fine. It's just the PTSD that is holding people back. Look at, I don't know, let's say GM. We've talked about GM before. GM's done 65% return in the past year. That's a value stock. GM, right? Make value stocks great again. That's an example, but there are others out there too. I think one of the things, remember Innova? I've talked about Innova before too. This has done 72% in the last year. This is consumer finance. So I think this theme will do well next year also. You could have bought Innova at a 6 times PE ratio. I want to say like a year and a half ago. I had a podcast summer of last year talking about consumer finance. Synchrony. Another one. Interesting thing about Synchrony is this lending, but these are non-bank lenders. They're not bank lenders. They're taking more credit risk. Synchrony is a leader in private label credit cards. If you go to Macy's, that Macy's card, the lending on the back end's from Synchrony. They're into the elective health business too. They're lending against elective health, which I think is a growth category. No, I think I know. It's a growth category. Just look at how many people are getting Botox procedures. Elective's better than insurance because insurance, you're tied up with Congress. Like, are they going to extend the Affordable Care Act? What about the public exchanges? Elective health is a bet on baby boomers wanting to extend their life and improve their aesthetics, and they're generally price insensitive, and it's a trend. And yeah, that's what they're spending on, among other things, right? I would like to find more elective health opportunities, by the way. If you have good ideas, let me know. I think it's a super interesting idea. It's kind of hard to invest in though, because, for example, I do think NAD infusion has some legs as a trend, but how do you invest in it? You can't really invest in the suppliers. There's no moat. You can't really invest in the delivery providers. There's no moat. So that's the issue there. But there is this gap in the market for branded providers of elective health services and like acute pain treatment. That category, I think, would do extremely well in private markets and senior living. So, you've got brands in a lot of categories, right? Remember before there was Jersey Mike's Subs, which Blackstone bought for $8 billion. You had all these mom and pop sandwich and deli places. That's still around today, but brands have a lot of value, the consistency, the experience, and other elements. And where are the great brands in these categories? I think that's a great private markets opportunity, right? I don't have a play there, by the way. I'm literally asking you if you find a play there. Senior living is another one. There are a couple of these senior living plays in public markets, but they are pricey. In private markets, I think that's the opportunity set. Like, there's probably a lot of people out there saying, gee, how do I get into OpenAI? I'd rather say, find me a senior living facility, like a team with a proven track record where they've got skin in the game. And I'd love to get involved with that in the right markets. Maybe they're in Texas, Florida, Raleigh-Durham, North Carolina. That would be interesting, wouldn't it? And then maybe there's a path to public markets. That, I think, is a far more interesting opportunity. bet on the baby boomers. Look at where they're spending, look at the services they need, and just follow the money, right? So I would say that no one's talking about that stuff, guys, right? Have you noticed that? Who the hell's talking about that? You got to be contrarian and non-consensus, and you have to have courage to have a different point of view. And a lot of people just don't think. They react to headlines. Here's an example. Remember Google? Google was one of our big names. We wrote about. I've actually cut back my Google position quite a bit. The only reason I haven't cut a lot more is because of taxes. But we sold out of it in our non-margin non-taxable accounts. But 2.5 weeks ago, there was this euphoria around Google, and euphorias are the opposite of when you see everyone looking at a name and capitulating. But when everyone's seeing the opportunity, generally, you probably often get substandard returns afterwards. Okay, so I'm going to share one of my favorite quotes from John Templeton. It's bull markets are born on pessimism, and they end in optimism and euphoria, right? And we had that with Google, and the stock's been down since those highs. Isn't that interesting? So often when you're browsing on Twitter and you have an idea, you have to ask yourself, where are you in that information cycle? Are you late to the party? Or are you early to the party? You're probably late to the party. Probably late to the party. So this is why having your own independent idea generation is important. And if you're on the ball and you're always looking at ideas, you know where you are in that information dispersion cycle. It's like moving out in concentric circles, like a ripple in the water. Where are you in that information? Comcast, good example. That was last week. We know we're like ground zero there, and it's broadening out. And consumer finance. I don't think that's ground zero. That's kind of like a midway developed theme, but that is, you have to have that kind of awareness. So here's a name, here's an idea, people. We will share an idea with you here today. Funny thing is, I have people that just say, Ron, just tell me what to buy. I don't want the background, the theory. Okay, here's an idea. So an idea, we bought this the last 2 days, by the way. I have like a couple points on it, 3 points to put in perspective. Plus or minus, mileage may vary. But that's a decently sized position for us out of awareness. So this is Coupang. So Coupang, the CEO, actually resigned. They had a big data breach. Remember Equifax? They had a big data breach. The stock just kind of destroyed, capitulated. The CEO didn't show up when kind of their version of Congress, Parliament convened. And this is a Druck stock. I never owned it. Just because Druck owns it doesn't mean you should own it. Really hasn't done much at all. It's done 1 year, 2% return. It's the Amazon of South Korea. The other Amazon out there is like Mercado Libre in Brazil. This is so. In the newsletter we walk through a write-up on this. I'll share that here. The valuations look a bit high with that PE ratio. I think the relevant metric here is price to sales. It looks pretty cheap, 1.1 times. It's a lot cheaper than Amazon, a lot cheaper than Mercado Libre. 1.1 times forward, 1.3 trailing. Price to book, 9 times. It's still in expansion and growth mode, so those PEs will be more elevated. The price to free cash will be more elevated. But if you look at the technical picture too, when it's this dislocated below the 200-day moving average, it gets bought. And there was no credit card data leaked. This was email addresses. I have a newsflash for you. Your email address is already on the dark web, right? It's already on the dark web, people. That's it. I think the consequences will be less significant than the market is implying. I don't think that this deserves a significant discount. And I expect people will get over it. The other thing is, that name was also owned by a lot of South Koreans. This is a funny thing about public markets. Like, governments don't want to destroy the crown jewel enterprises. Equifax wasn't even a crown jewel. I hope it gets disrupted. But what were the fines and penalties for Equifax? Does anyone even remember when they had a very severe data breach where private information was compromised and in the hands of like hackers from maybe the Lazarus Group or China? We don't know. What were the real consequences and repercussions? Not much. Now, South Korea is not the United States. They might take a different approach. They have more accountability there. The CEO self-resigned, kind of amazing. Kudos to that culture. Really admirable for taking accountability there. But I think a lot of damage is priced in. The question is, has this changed anything about Coupang's competitive positioning? Has it changed their positioning in the market? Has it left an enduring mark that's negative on their brand? Has it impacted the long-term earnings trajectory and the opportunity that they're getting after? I think that's the right way to analyze it. And my view, the answer is no. The answer is no. And so that's why I like it. It reminds me of this. I'll tell you another Buffett story. So it was in 1963. There's a American Express had an investment in or they had a deal with the Salad Oil Company. I'm going to share this story from GPT, so it'll fill in the blanks for me. But it was a big scandal. So there's a commodities trader, and he was using these tanks, and they were supposedly filled with salad oil. It was collateral. I guess that was a thing back then. Salad oil is collateral. And most of the tanks were actually filled with seawater. It was a case of fraud. American Express's warehousing subsidiary had guaranteed the receipts. So when the fraud was revealed, markets feared a lot of catastrophic liabilities, loss of trust in the brand. The stock fell 50%. Sounds familiar. No one remembers that. That's ancient history. No one remembers Equifax breach. That's ancient history. So, he did some analysis. He bought it. I just shared with you my analysis. There's more in the newsletter. And, it's, a little bit more on this. We'll move past that. But the revenue's grown high double digits in the last 3 quarters. Gross margins 30%, top of the historical range. And I like revenue growth, 18% revenue growth. Yeah, the magic number is like 20%, but 18% is good enough if I'm getting at this price. I'll take it for a dominant market leading franchise with a brand, with a quality position. I don't think you're going to get user churn off of this. So there you go. There's an idea. There's Coupang. We bought more than a few things this past week, by the way, but trying to highlight one idea per week. And let me share my screen again for you all. So one of the things we do in the ledger, by the way, is we go through curations around kind of like AI-related themes and market podcasts, and also health and longevity. There's so much information out there. So, and we also have these like Twitter accounts at Lumida Health. So if you want to stay plugged into the latest like health tips, hacks, or reminders, whether it's sleep or managing cortisol, you can check out at Lumida Health. We also just run earnings at Lumida Earnings on X, do real-time earnings. So we have an AI bot that does this. It's super cool. Gets the main highlights. We also include a meme. So we have fun. We like to have fun with the stuff. I think so. I think I'll conclude on digital assets. I mean, we share this in Ledger 2. Look, I think the bull market's over there. I think it's over there. I think the hype is ahead of reality. I've shared thoughts on this in bits and bips the last few weeks. I think, in the aftermath of this DAT IPO, you've got people holding too much stock and of these DATs, and I think it's hard to get M&A done because there's too much structure in these DATs. That's the issue. And when you have a busted IPO and a string of them, it just hurts sentiment and confidence. And Chris Perkins used this term, the Empire Strikes Back. I think that's the right term. It's like a revenge of TradFi. They're all over this. They're using digital asset technology. It's like the thesis has been proven out. It's one. Digital assets are going to reshape financial services. Perhaps not in the way people anticipated. I still think there's a big opportunity around decentralized finance, etc. But hype is just ahead of reality. I was at a conference 2 months ago in October. I shared an FSD video about it at the time. And the guy to my left on the panel was talking about AI agents and digital assets. What is this guy talking about? I mean, I get AI agents are going to have transformational impact, but the point is that it's a reach for a narrative to justify current prices. And when you see narrative reach, you should start asking questions. When you have high prices, you got to say, well, what's baked in? Like, what's the over under on this? And there's a lot of hype versus reality. So those are my thoughts there. I do think there'll be great opportunities that'll set up eventually. Maybe next year, there'll be some real value. There'll be some dislocation. It's funny. I've seen people on X say, hey, look, I like following Ram for the macro on the stocks, but I ignore the digital assets. But I think we've shown you can make money in digital assets if you're on the right side of the trend. You buy low, sell high. Buying Bitcoin in 2023 Q1, that did really well. That was in the 20s. You exit around 98, 100, 107. That's pretty good for a couple of years, right? So it's just a different style of investing. It's called momentum or animal spirits. And there's a way to do it, and there's an approach. Where is that momentum going now? I think it's going to categories like biotech. That's it. Biotech is going to get some kind of bid, and eventually it'll have a parabola, and then that party will be over. But that's how the human fear and greed cycles work, right? I think one of the things, if you really want to develop the skill of investing, which is the hardest multiplayer game in the world, PvP game in the world, then you have to go meta. You can't be, hey, I'm a value investor, I'm a growth investor, I'm a high beta investor, I'm an animal spirits investor. You have to go meta. You have to say, what are these styles and when do they work, and how do I develop the skills and tool set around them? How do I approach that with the skill set, and can I get exposure to different distinct themes that together make a good portfolio? That's the approach I'm taking anyway. And it's hard to do because usually people gravitate towards a style based on their disposition. Okay. Like, I have a bias to value just by my nature, but I've learned to appreciate the power of momentum because I can see it in the data. So I want to own things in uptrends. Okay. I like things in uptrends. Okay. Now and then we buy the dip. I just showed you with like Coupang. It's a high quality dislocated asset, which is another part of the framework. There are different kinds of frameworks and approaches that you can take. So, like if you've had a big drawdown in the last 1 month, you might be doing just one style and you think you're diversified, and you're actually not, because so many things are just correlated to one factor. There are a lot of ways to invest and do well. Find distinct approaches, put it together in a portfolio. So themes that are working, I'll wrap up there. Consumer finance, we walked through some names there. Regional banks doing well. Who's talking about regional banks? They're hitting like 52-week highs. They're doing well. Consumer strong, Fed's cutting rate. Defaults and delinquencies aren't that much of an issue. You're through a lot of the commercial real estate issues that we've seen in the last few years, and you've got deregulation. That's done well. Look at like Citizen. Citizen still is one of our holdings. I think it's still got like a 2.6% dividend yield too. And I shared that as a measure of value. People will look at that and they'll say there's value there, right? Auto companies, the GMs of the world, they're doing well. So still like Meta, I think Meta is still in a really good spot. Here's a fun fact. Meta will generate 40% of the earnings per share growth in the S&P next year. Isn't that amazing? That's pretty interesting. So what else? So more to come. We'll share our views next year and ideas we like. We have a list of 2026 ideas. There's some really novel ideas that people are not talking about. We're looking at the name. We're like, gee, this looks super interesting. We think we can get behind that. It's funny. It's often those random names that do really well. I remember 2 years ago, we put Build-A-Bear on our stocking stuffer list. This is hilarious. I went to Building Bear last night, by the way. I don't own it right now, but I stopped by the mall. I'm still busy. But let me show you Build-A-Bear. Build-A-Bear at the time had like a 6 times PE ratio. It's bananas. It's done a 29% return in the last 1 year, by the way. Yeah, in like January 2024, it was $23. It's $54 now. So it's like a double. So now the PE ratio is like 12 and 14 times, right? So like value can work as long as you avoid the value traps. So the way you measure that is there earnings growth, is there revenue growth, is revenue growth exceeding inflation? Is there operating leverage in the business? Make sure there's not high share-based compensation issues. Try to figure out what's causing it to be low. Is it thematic? A lot of this was thematic. People didn't like retailers. But anyway, so hopefully that was helpful. We'll call it a wrap. I hope you all have a wonderful holiday and Christmas. I'll probably be spending time in Virginia this week. So doing some last minute plans here. And thanks for being a part of the journey. I appreciate you spending time with us. I know where you spend your attention it's very valuable. We try to offer perspective and insight and signal to the best we can. And we have big things in store for 2026. We're going to do a Lumida crowdfunding offering. We'll be the first wealth manager, asset manager, to my knowledge, that's ever done this. It's a big deal. We've got a great community on Telegram and on multiple channels. They've been a source of our success. And the idea is launch an ETF next year, launch an AI investing app called Lumida Invest, which you can access on the Test Flight store. DM me or go to lumidacopilot.com if you want to get on the kind of the beta version of that. It's real and it is capable. So want to do more events. That's kind of our broad brushstrokes of 2026. And I think the legacy investing world is broken. Wealth management is broken. It is so ripe to be disrupted. I think AI is going to transform that. I think we're going to see avatars replace financial advisors. I think you're going to see quant models replace a lot of these kind of old approaches. And we think, private markets will have a role to play and alternative investments will have a role to play in all this stuff. So stay tuned for that. Exciting things coming up for next year. Make it all a great holiday. Be well, folks.